Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending September 2nd, 2022. Looking at the indexes for the week, the TSX, S&P 500, Dow Jones, NASDAQ, and the Russell 2000 were all down this week, mostly continuing the drop from last Friday following Jerome Powell's speech from Jackson Hole, promising to be tough on inflation and continuing to raise interest rates. Jerome Powell also said that a recession is inevitable, with a warning to investors. Gold and oil were also down for the week. Oil prices slumped as the summer driving season came to an end. On Wednesday, we had the important Canadian GDP reports, with the year-over-year GDP for Q2 up 4.5%, but the GDP annualized quarter-over-quarter for Q2 was up only 3.3%, less than expected. None of these were negative to put us into a recession. Friday, we learned the U.S. labor market added 315,000 jobs last month, hitting a 20-month streak in strong job growth that's powering an economy through ominously high inflation. The U.S. unemployment rate ticked up slightly to 3.7%, according to the monthly jobs report released by the Bureau of Labor Statistics on Friday, September 2nd. Some 344,000 more people were unemployed than in July, partly because more workers rejoined the labor force, newly looking for work. Over the past year, average hourly wages have increased 5.2%. The market saw this as a negative, however, because the U.S. central bank will need to keep increasing interest rates to slow down the inflation and the economy. Investors are cautious heading into September, which statistically has proven to be the worst trading month for equities. It was just earlier this month that investors were predicting the beginning of the next bull run. Then, stocks were building on their July gains thanks to a combination of bear sentiment fatigue and corporate and consumer resilience in the face of inflation. This week, however, markets are digesting newer inflation-fighting comments from the U.S. Fed last week and a spike in the 10-year U.S. Treasury yield. This has contributed to declines in stocks. It's a cycle that's likely to continue through the rest of the year. Looking at some of the Canadian bank reports, BMO missed profit expectations, had less profits from capital markets than expected, but had strength in Canadian and U.S. personal banking, and interest margins improved on loans, along with strong loan growth, including commercial loans. Laurentian Bank had a narrow earnings per share miss for Q2, but Lululemon has had a standout Q2 report, with the shares up 11% on Friday following their reporting. There was a TD Economics paper that is looking at steep housing declines in BC and Ontario. Prices are down 15% from the peak in February in Canada so far, and TD expects them to fall 20 to 25% from the peak. BC and Ontario will be even worse than that. Turning back to the US job openings top 11.2 million in July, well above estimate and nearly double the available workers. So the employment picture in the US is looking very good. Private payrolls increased by 132,000 for August, and weekly jobless claims dropped to 232,000. This, of course, gives the US Fed more reason to keep raising interest rates. Some experts don't believe the central banks have the political stomach to put us into a recession, but I think they will do it to stop inflation, but are aiming for a soft landing and a mild recession at worst. If there is a recession, it won't be until next year. Oil is still expected to rise because of the small amount available and being produced. Meanwhile, Europe got natural gas price reprieve as they seem to have significant inventories being built up in Germany. As the economy slows down due to the interest hikes in the US, it's likely some oil demand will leave the system. Price increases in the Eurozone hit a new record this month, according to Europe's Statistics Authority. Inflation rose at a rate of 9.1%, slightly beating the economist's projection of 9% flat. It marks the ninth straight month of record consumer price increases. The main culprit is energy prices, a consequence of Russia's war on Ukraine. Adding to that anxiety is a scheduled maintenance period from Wednesday through Sunday for the Nord Stream 1 gas pipeline, which runs Russia to Germany. Russia has gradually choked off gas supply in recent weeks, which Germany considers a political move as European nations support Ukraine in the war and prepare for the coming winter. Retail goods inventories in the US are still high, causing worries that retailers will have to discount their products to lower the inventories, thereby losing margins. The central banks will prefer to put their economies into recessions to having significant inflation. Inflation is far worse since prices aren't stable and no one can plan their purchases. If we go into a recession, the banks just cut the rates. Worst case scenario would be to have a recession and inflation, or stagflation. It wouldn't be a surprise to have the central banks increase interest rates until there is a recession, however. Turning to China, the US-China audit agreement is looking good. The SEC and Chinese regulators will allow audit reviews to take place in China on the Chinese company audits, which would stave off the threat of delisting the US-traded ADRs of big Chinese companies. Chinese companies are being audited by the US Big Four auditors, so the reviews should go smoothly. The Chinese ADRs are trading at half the PE than the equivalent US companies are because of the various risks for the Chinese stocks, including the Chinese government crackdown, so the prices don't reflect the company's true fundamentals. The China and US stare-down over Taiwan continues. China and the US need to continue to communicate and use diplomacy. The two countries' militaries also need to communicate to prevent accidental incidents. On Thursday, the US government forbade the sale of US artificial intelligence chips to China, hitting NVIDIA and AMD sales expectations. And finally, the Chinese citywide shutdowns continue to hamper their economy. The 27 million people in Chengdu are locked down, preventing the industrial city from producing anything. Looking at earnings for next week, NEO reports Wednesday and Dollarama is Friday as Q2 earnings season winds up. Looking at economics event next week, Wednesday is the Bank of Canada interest rate decision. About 0.7% rate hike is showing in the bond market. So the market is thinking the likelihood is high for a 0.75% rate hike. With high wage inflation and high core CPI, they might be right. September 8th is the US oil inventory and imports numbers, and Friday is the Canadian unemployment data for August. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.